Welcome to this special session in which we will present and discuss the top findings of BNamericas 2023 Oil and Gas Survey for Latin America. The survey was carried out with support from Deloitte and from the Association of Oil, Gas, and Renewable Energy Companies of Latin America and the Caribbean, Arpel. My name is Laura Superno. I am the Managing Editor for Research at BNamericas. Today, we will spend a few minutes looking at the results of the survey on the key questions for the industry, and then Michael Place, BNamericas Regional Energy Editor, and Miguel Moyano, Senior Managing Director at Arpel, will analyze the results and discuss industry trends including spending, political risk, decarbonization, and financing in the context of the energy transition. The full results of the survey can be found on the BNamericas platform in the report Oil and Gas Survey 2023, Riding on a Wave of Optimism. As the title of the report suggests, we are observing a firm return to optimism this year in Latin America's oil and gas sector. CapEx budgets this year are stronger, and the survey shows that 63% of all respondents either plan to increase spending in 2023 or they believe spending is on the rise in the industry in general. A year ago, just 42% of respondents forecast higher spending for the year ahead. However, we did see slightly fewer respondents in 2023 believing that oil exploration activity will grow in the near or the medium term, while a larger proportion believes that activity will stay at its current levels. However, fewer people did say this year that exploration activity will decline in the year ahead. When asked where the best opportunities for exploration investment can be found, the largest percentage of respondents said deepwater areas, followed by conventional onshore areas, unconventional onshore, and finally shallow water targets. Inflation will continue to impact the activity and the financial performance of oil and gas companies in Latin America over the coming year. Although slightly fewer respondents in 2023 envision a big impact in the coming months as compared to the impact over the past year, slightly more think that the impact will be moderate. But we are still seeing an overall 83% of respondents expecting to see a medium or large burden from inflation the year ahead, which is similar to the result we saw last year. A strong increase is visible in the amount of people who say their company will increase spending on decarbonization in the coming year, 60% versus 42% a year ago. And of that 60%, 10% said the increase will be significant, while 50% are simply projecting an increase. The category of digitalization and greater operational efficiency is considered to be the most important change that E&P companies should focus on in order to stay relevant in the accelerating shift to clean energy. And that's followed by the prioritization of natural gas. Carbon capture and clean hydrogen, followed by renewable power self-generation, were the third and fourth most popular responses in terms of what E&P companies need to focus on. And lastly, the threats related to political risk, legal uncertainty, and resource nationalism as a group are in the first place by far as the biggest threat to Latin America's oil and gas industry, with 59% of the responses in 2023. This percentage, however, was somewhat lower than in last year's survey, and we can observe this year increases in the perception that community risks, financing, or regulatory barriers are the biggest threat in the next 12 months, but these still remain a minority of responses. Thank you very much for your attention. And as I mentioned earlier, BNamericas Regional Energy Editor Michael Place will now discuss the survey results and key trends for the industry with Miguel Moyano, Senior Managing Director at the Association of Oil, Gas, and Renewable Energy Companies of Latin America and the Caribbean, Arpel.
Thank you very much, Laura, for that interesting presentation. Now we are joined, as Laura mentioned, by Miguel Moyano from Arpel. Miguel, thank you for joining us.
Hi, everyone. How are you doing, Michael?
Very well. Thank you very much. Well, as Laura mentioned, the survey showed an increase in people and companies planning to raise investments over the next 12 months, with the figure being 63% compared to 42% last year. Broadly speaking, Miguel, what do you think are the main reasons for that? How has the landscape changed? What is motivating this increased optimism in your view?
Well, I think, Michael, it could be important to see the origin of the responses, but I think we can provide an idea of the rationale behind those figures if we analyze what's been going on lately in some countries, not all of them, of course, but for example, in Brazil, the recently elected government started with several pledges, including reducing poverty numbers and addressing the decarbonization of the economy, utilizing the profits derived from its hydrocarbon wealth to develop the social programs and the just energy transitions programs in Brazil. So the decisions to increase investment in Brazil is probably driven by Petrobras and other IOCs to secure a near-term exploration success to help offset the steep declines from 2030 on against IBAMA's long-time denial of the Petrobras exploration drilling permit, which was recently approved. In Argentina, the production of natural gas from Vaca Muerta is going to be boosted by the new pipeline and the decline of Bolivia production, which, by the way, is fostering the development of an Argentine pipeline project designed to help support the flow of Neuquén basin gas to the north of the country. And also in Argentina, the possible development of LNG exports is being considered, right? And of course, there are high expectations in the offshore development of the northern Argentina basin, which, by the way, raises expectations in the offshore exploration in my country, Uruguay. And of course, we have the Guyana-Suriname basin, the jewel of the crown, which is also part of the equatorial margin, right? And Guyana current production is like 400,000 barrels per day, and they're projecting over 1 million barrels of oil equivalent per day in 4 years. So added to this is the recent visit of Total Energy CEO to Suriname, confirming the first field development offshore Suriname. So none of these initiatives that I just mentioned will be possible without an increased investment, including those of oilfield service providers, of course. Although I'm sure that the business decision may not have been made without some meditation by the company's executives, given the responses we just heard from Laura.
Thank you, Miguel. There certainly is a lot of interesting activity happening throughout the region, as you mentioned, from as far afield as Guyana down to Argentina and elsewhere, with a great variety of different projects, as you mentioned. So some exciting times in the oil and gas industry. The survey indicates a better opinion about the conditions for financing, and there were also quite a few respondents who said that they expected to raise capital this year. I guess one of the burning questions is that there is a belief that banks cannot support the Paris Agreement to reduce carbon emissions and at the same time finance oil and gas projects. It seemed not to be compatible. But then there is another argument that says that that banks, if they don't support oil and gas, then they're undermining energy security and driving up energy prices. How can that be reconciled? What does Arpel think about this dilemma, and how do you think it can be resolved?
Thank you, Michael. This is really important. I mean, the debate on this dilemma you're talking about is very useful to clarify what the financial institutions can actually do to support the transition to low carbon energy and what actions could be counterproductive. Banks can, in fact, continue to finance new oil and gas production while meeting their emissions reduction targets, but there are new frameworks and commitments and pressure from policymakers and regulators that are creating tensions that have yet to be resolved. 3 years ago, actually, in 2020, the UN Race to Zero campaign prescribed mandatory climate criteria for the Net Zero Banking Alliance, requiring their members to restrict the development, financing, and facilitation of new fossil fuel assets. This campaign explicitly referred to the International Energy Agency Net Zero scenario developed in 2021, which envisages that no greenfield oil and gas development would be required. And this, of course, created some concern for the banks. So in response to those concerns from the banks, the UN issued a revised guidance in June last year, right, just 1 year ago, requiring the members to commit to gradually reducing support for fossil fuels. But this time, they said that it should be in accordance with appropriate global science-based scenarios to limit the global warming to 1.5 degrees. So this revised language aligned to the Race Zero with the original Glasgow Finance Alliance for Net Zero guidance, right? Which was clearly not intended, this last one, the Glasgow Alliance, was not intended to stop all the financing of new oil and gas development, but rather designed to encourage lenders and investors to manage and engage with businesses to support a transition to Paris-aligned business models. However, despite the fact that this new approach to Race Zero is somewhat more practicable and reflects the real-world constraints, just 1 year ago, last year again, the Glasgow Financial Alliance resigned from its membership to Race Zero. However, several of the banks members of the Glasgow Alliance still have targets for 2030 for their clients in the oil and gas industry in scopes 1, 2, and 3, right? In carbon intensity, in reducing carbon intensity, right? So these objectives mean that although banks can continue to finance new oil and gas development, they can be more selective about the projects they are financing. The banks will work with the customers to help achieve emissions reductions and will have incentives to support emissions reduction activities, including carbon capture, use and storage, and carbon offsets. And because the targets are framed in terms of intensity, they will have incentives to support the low carbon energy financing, such as wind and solar. And that will reduce their total portfolio emissions per megawatt hour. So this is a pragmatic approach from the financial sector that Arpel believes can help solve the dilemma of financing hydrocarbon projects, while at the same time supporting decarbonization at a pace that does not undermine the energy security that you were talking.
Yeah, really interesting response, Miguel. As you mentioned, it's a pragmatic approach, and I think that's what's called for, pragmatism and just common sense, I guess, and flexibility, I guess, in what the targets are. So I think the industry is in wholehearted agreement with that response. The percentage of companies and respondents to the survey that said they would increase decarbonisation activities over the next 12 months increased to 60% from 42%. And this figure is actually quite surprising for me. 78% agreed that there would be an impact on their organisation due to model changes related to the energy transition. In your opinion, what are the main strategies that E&P companies or operators in Latin America can adopt to adapt to the clean energy transition and to remain relevant?
You know, Michael, this question reminds me when Arpel, like 25 years ago, developed a guideline on environmental costs for the oil and gas industry. We needed to identify and separate the direct and indirect environmental costs. The direct costs were defined as those costs that were due primarily to environmental reasons stemming from cost drivers such as environmental legislation. But on the other hand, indirect environmental costs were defined as expenditures that were made primarily for purposes other than environment, but that would have some link with the environment in terms of enhanced environmental protection. So the sum of these direct and indirect costs were the total environmental cost that we defined. Now, going to the question of the survey, I'm not sure if there is a definition globally agreed for what the surveys say of spending on decarbonization activities. So I don't know if the survey participants were answering about investments on decarbonization projects driven by regulatory requirements, so that would be direct cost, right? Or by the increased operational efficiency with an impact on emissions reductions, which is an indirect cost. Or it could be both of them. So in any way, Arpel is aware that many of our companies are operating, are working and doing their part very proactively to transform themselves. They're adopting measures, strategies, and even new business models right? To have portfolios with lower emissions. Moreover, I mean, some of them have established short and medium term targets of reduced emissions intensity and in absolute terms as well. So in the short term, of course, the focus is on the low-hanging fruit, improving operational and energy efficiencies, both of them, and then minimizing venting, flaring, leaks of methane, recovering vapors, etc. Right? And of course, they are fully embarking on the technology and digital transformation that facilitates those efficiencies. But they are also diversifying the energy supply operations by seeking more natural gas weight in their portfolio, okay, and venturing into lithium mining, solar, wind power, geothermal, blue and green hydrogen. Furthermore, some are offsetting their carbon emissions through nature-based solutions like large-scale deforestation. Some examples, very short. Pan American Energy is constructing an onshore wind complex in Brazil with investments of $700 million with an installed capacity of 400 megawatts. In Brazil, Petrobras created the Energy Transition and Sustainability Area Department, which is represented at the board and is dedicating between 6 and 15% of their capex to low carbon investments. That is very large, right? So in the short term, they're working on biofuels for road and maritime transportation, sustainable aviation fuels, using carbon capture and storage in the pre-salt basin. And also with Ecuador, they have just signed an agreement to install 14 gigawatt offshore wind facility. Another example, in Argentina in 2018, YPF, the NOC, launched YPF Luz, which is the group's energy company, which is #3 player in electric power generation in Argentina and #1 renewable energy company in Argentina. And 20% of its own generation comes from renewables. So although companies in our sector are facing these types of learning curves, the cost of renewable energy should continue to decrease, with their increase in scale, making more attractive as a natural portfolio investment. So it's interesting to mention that some of the technologically and economically feasible renewable energy projects may not be promptly implemented, sometimes because there is no regulatory framework in several countries of the region.
Very interesting. And I think you mentioned the fact that oil and gas companies are investing more in not only decarbonization of their existing operations, but going into new businesses, renewable energy, hydrocarbon, hydrogen, carbon capture. The Petrobras, I think, is a leader in the region. We're seeing Shell and Equinor investing in offshore wind. So there's kind of a blurring of the lines between electric power and oil and gas. And I think that's going to be a trend for the future. As you mentioned, there are so many elements to oil and gas that can be decarbonized and areas where new businesses can be formed. So it's a fascinating thing to look for in the future, to look out for. As in previous years, the survey showed that the majority of respondents saw political risk as the major threat. I guess that wasn't a surprise that occurred again. There was a small increase in the number of people who said community issues and a lack of funding or regulatory barriers would be the greatest threat in the near term compared to the last survey. How do you evaluate this result? Specifically, I guess talking about, I imagine you don't want to talk too much about political issues, but how do you see the perception that the industry has about the biggest threats for oil and gas, and how can oil and gas companies address these perceived risks?
Mm-hmm. Political risk with oil and gas exploration vary significantly from one country to another, and the risk associated to community issues, lack of funding or regulatory barriers are also common elsewhere in the world, not only in Latin America. We are not an exception. So the very risks are differently weighed in different countries, and I'm sure that the audience listening to this webinar is well informed about those that may be more relevant in some individual countries. So, as you said, I will not go into the details, since the oil and gas industry is used to deal with this risk, some of which can be mitigated by joint venturing with the NOCs or engaging with local stakeholders. For what I will speak about is the attractiveness of the Latin American region to invest in oil and gas exploration, which is diverse and very large, and with the expectations of rewards that compensate for these risks. I will not try to rank individually the attractiveness of all the countries in Latin America, but I want to point out that there are almost 200 operators in the region. This includes, beyond the NOCs, the IOCs, juniors, independents, okay? And they have different strategies, they have different portfolios, they have different know-hows, including offshore basins, deep offshore, mature fields, unconventionals, heavy oils. And since our region has a diverse appeal to invest in oil and gas exploration and production, every company will find a niche country to use its skills to the competitive advantage of that, right? So an additional risk factor related to energy transitions demands from society at large is the move that some IOCs are taking to ensure that the emissions intensities, which derive from extraction and flaring, of course, are further reduced so they can comply with their decarbonization targets. And this has implications in the selection of hydrocarbons that they're looking after. So this means that they will aim for lighter crude with lower kilograms of carbon dioxide per barrel of oil equivalent produced, right? And this factor must be considered by the hydrocarbon agencies in the contractual terms if they wish to remain competitive to attract investments. All in all, and as a corollary of this very summarized evaluation, I think it's important to evaluate the results of the BNamericas survey that we are presenting here, and this part in particular with the governmental authorities. These risks have an impact in the investment climate and the operational stability of the companies operating or willing to operate in the region. Our industry is global, money goes where the ratio of the risk reward is the lowest, right? And this is a factor that governments consider or should consider in their policies, right? But it's also something that Arpel regularly discusses with the key governmental stakeholders to collaborate in the sustainable development of our sector in Latin America. And actually, this issue is going to be part of the agenda of our biannual conference in Cartagena de Indias next April 2024 in Colombia.
Great, Miguel. I'll jot that down in my diary for next year, early next year. Thanks for the reminder. Thank you for joining us, Miguel. It's been wonderful talking with you again. You've been very insightful. It's been a fascinating discussion. Thank you very much for your time.
Thank you, Michael. Thank you for inviting Arpel.
Fantastic. Well, with that, we'll hand it back to Laura. Thank you very much.
Thank you very much again to Miguel and to Arpel for being part of the discussion today. I'd also like to thank everyone watching. I hope it's been insightful for everyone. I remind our subscribers, you may read the complete report of the oil and gas survey on our platform. And for those of you who are not yet BNamericas subscribers, I invite you to visit BNamericas.com, where you will find a variety of data, news, and reports on oil and gas and other sectors in Latin America. Thanks again. Have a great day.